You're watching Magnetic Media News Network. I'm Mia Kudos. This is Behind the Headlines, because what matters isn't only what happened, it's what happens next. Let's begin. Today, the Federal Reserve made a highly anticipated decision to hold interest rates steady, keeping the benchmark rate in the 5.25% to 5.5% range. This marks the second consecutive meeting where rates have remained unchanged, following a prolonged period of aggressive hikes aimed at taming inflation. The decision was unanimous, reflecting a cautious but deliberate approach as policymakers assess the evolving economic landscape. So, what does this mean? At its core, the Fed's pause signals confidence that its previous rate hikes are working to cool inflation without yet tipping the economy into a recession. However, it also reflects uncertainty about the path forward. Inflation remains above the Fed's 2% target, but recent data suggests it is moderating. Meanwhile, the labor market remains resilient, with unemployment near historic lows. This balancing act suggests the Fed is prioritizing stability over haste, giving itself room to maneuver as new data emerges. The ramifications of this decision are far-reaching. First, markets are likely to remain volatile as investors recalibrate their expectations. A prolonged pause could support equities, particularly growth sectors like technology, which are sensitive to borrowing costs. However, if inflation proves stickier than anticipated, the Fed may signal further hikes, which could reignite market jitters. Second, consumers and businesses will continue to face elevated borrowing costs, which could weigh on spending and investment. Mortgage rates, credit card debt, and corporate loans will remain expensive, potentially slowing economic activity in interest-sensitive sectors like housing and automotive. What should we watch next? Keep a close eye on two key signals. First, upcoming inflation reports, particularly the Personal Consumption Expenditures Price Index, will be critical in shaping the Fed's next moves. A surprise uptick in inflation could force the Fed's hand, while continued moderation may pave the way for rate cuts later in the year. Second, labor market data will be equally important. Any signs of weakening employment could shift the Fed's focus from inflation to growth, altering the trajectory of monetary policy. So, what is the smart money doing? Smart money. Neutral. While some investors are positioning for a soft landing, others remain cautious about potential upside risks to inflation or downside risks to growth. That is what sits behind today's headlines. Thank you for joining us for Behind the Headlines. Until next time, stay informed, stay ahead. And if you haven't already, subscribe for more intelligent analysis, Monday to Friday.